That is the closing bell on Wall Street, and now it is market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Julie Hyman, Josh Schaefer, as well as Chris Versace, Tematica Research Chief Investment Officer, here with me. Let's get it down to Julie Hyman, the New York Stock Exchange, for more Where We Close. Julie.
Yeah, so we ended up having that rally really take hold today, even though we heard Jay Powell, the Federal Reserve Chair, expressing patience, continued patience, but the market doesn't necessarily believe him. They're looking for rate cuts to potentially happen sooner rather than later. We see the S&P 500 closing higher by more than 1%, the Dow as well. The NASDAQ leading the gains, up 1.4%. And indeed, if we look at the NASDAQ 100, it's closing just a hair shy, a few points shy of a new record. The new record for the NASDAQ 100 would be 22,199, give or take, so closing just below those levels. But seeing this continued gain here for the major averages, which we've talked about, is fairly remarkable given where we were just a few months ago. By the way, if you're wondering about the S&P 500 and how close it is to a new record, that was around 6144, so we are not quite there yet. Josh?
Hey, Julie, a boisterous crowd down there on Wall Street today. I think they're excited about this rally we've been watching all day long. So taking a look inside what happened inside the S&P 500, you had tech lead the way, rising more than 1.8%. Tech and comm services, I should point out, we had sort of a broad tech rally on hold today, and that's really been the trend over the past 5 days, over the past 10 days. So I'll take a look at a 5-day here. You can see tech outperforming there. Then we go out to a 10-day period. Again, tech, comm services, your outperformers. Now, what I want to look at is interesting. A lot of times when we highlight tech and comm services, we're talking Magnificent Seven, right? These stocks right here. You see Amazon was up 2%. NVIDIA, I think, just missed an all-time close, but it is right near its record high. But when you zoom out and look over the last 10 days, this hasn't necessarily just been a Mag 7 rally. You could throw in Broadcom, which some people like to put in that big tech cohort, right? That's one of the large cap tech companies. Tesla is, of course, in the Mag 7, that's up 10% over the last 10 days. And then I'll just equal weight this out for us to take a look at what's really been moving. A lot of chips. You can see Intel up 10% over the last 10 days. Put on your 10-day there. And then you also just look broader. You're starting to see more of that AI trade, not just Mag 7. Palantir up 8% over the last 10 days. AMD up 13%. I'll finish on semis and just take a look at what happened within that sector on just a daily basis. Several semi stocks on fire today. ARM up over 4%, AMD up 6%, Micron also up almost 5%, Josh.
All right, thank you, Josh. For Chris, I want to bring you in here as well. Your first takes on the trading day, Chris. What'd you make of the moves we saw in these markets?
I think we're just seeing some relief that the Middle East tensions are dialing down. And now we can start to focus on the road ahead. Because remember, this entire Israel-Iran thing, I won't say it came out of nowhere, but I think it surprised a lot of people. It really upped the ante. There was that, rhetoric by President Trump, I will, I won't, I will, I won't. And then all of a sudden he did. And now we've seen the big ramp down, or what looks to be a big ramp down. So I think it's going to be back to business as usual.
How much, I know we talked about this earlier, but how much do you think, though, in today's trade, would you put on Jay Powell and the testimony on the Hill in that he's saying, listen, I'm good with where I'm at. I'm good to sit on my hands. He's also saying, though, in response to some lawmakers' questions, you know what? If inflation does remain contained, we could cut sooner rather than later.
Yeah, he's giving scenarios. That's all he's doing because he's waiting to see what the data brings. And, I mentioned this flash June PMI report earlier, not constructive, but we have a lot more data coming. Next week is probably one of the bigger data weeks that we'll have. We've got ISM's manufacturing and services data. We'll get new order information in that. We'll get employment information. We'll get inflation information in that. And what's important about all those ISM reports is they're factored into GDP. So that will help refine these rolling GDP forecasts that we see from the Atlanta Fed, the New York Fed, and others. And then we get ADP's numbers. And then interestingly enough, the employment report is on Thursday, which is a shortened market holiday because we're, of course, leaving early for July 4th, and the market's closed next Friday for the Independence Day holiday.
Got a lot of information coming at us very fast. Thank you. Stay right there. Fourth quarter results for FedEx. They are just crossing the wire. Let's get to Yahoo Finance's Julie Hyman with the very latest. Julie.
Yeah, FedEx numbers for its fiscal fourth quarter coming in better than estimated, $6.07. That's versus the $5.81 that was estimated on average by analysts. Sales coming in a little bit better as well at $22.2 billion, about $21.75 billion is what analysts have been estimating. Now, this is usually the quarter when FedEx would give its forecast for the full year. It's not doing that this time because of uncertainty. It's only giving its forecast for the fiscal first quarter of 2026. And that forecast is for earnings per share of $2.90 to $3.50, or if you exclude some one-time items, including costs related to the spinoff of its FedEx Freight division, $3.40 to $4 a share. Either way you slice it, that would be less than had been anticipated. Sales, the company says, should be flat to 2% growth, which leave that potentially in line with what analysts had been anticipating. The only thing the company told us about the full year is that its CapEx is pinned at around $4.5 billion. Now, the fourth quarter numbers, just to drill down a little bit there, the company gives a lot of credit to its so-called DRIVE program as the reason behind its beat last quarter. And that's its cost reduction program that it has been undergoing under CEO Raj Subramanian. The company also said it saw higher volumes at its Federal Express division and a higher base yields. On the flip side, it did see higher purchase transportation and wage rates. Remember, it also sunsetted its contract with the USPS, so that had an effect last quarter. Now, it's for its freight business. Now, remember, this is the business that hauls large stuff, large quantities of stuff, right? It's less than truckload business where it puts them all on a big truck together. That fell because of lower fuel surcharges, reduced weight per shipment, and higher healthcare costs. The company also said during the quarter it retired 12 aircraft. So a couple of different things to mention there, but I think the cost reduction is really what the company is pointing to. It'll be interesting to see and to get a little more color on the call behind that first quarter forecast and exactly what is going on there, what one-time items they're excluding in the two sets of numbers that they're giving investors, what's going on with costs related to FedEx Freight. And then there's also just a bigger question, and this is a question I posed to Raj Subramanian when I visited the company's transport hub in Memphis, which is what effects are tariffs having right now? And he said, he sort of tried to say this is an opportunity for FedEx to help our clients through this period. What effect will the de minimis exemption going away have on FedEx clients and therefore on shipment volumes? That remains to be seen. But again, kind of a lot of questions here for FedEx, and we'll see what they say on the call. Josh?
You know, Julie, this stock has not been working. I mean, heading into this print, it was down about 20% this year. It was down about 10% over the past 12 months. I'm looking at least the initial reaction. Investors aren't impressed in the after hours. What do you think investors have to hear to get more bullish and constructive on this name?
I mean, what I have heard from analysts is that part of what investors need to hear is out of FedEx's control. And that is a reacceleration in volumes, which would come from economic expansion, a pickup in demand for goods, things like that shipped through FedEx specifically. There are some analysts who think that the company is doing the right things in terms of this cost-cutting program, in terms of the spin-off of freight, in terms of sort of rationalizing and uniting its different networks, its air and its ground network, which is it's been something that some investors have called for quite some time. So it's tough to say, Josh, what would sort of turn things around for the company besides just an improvement in shipping volumes.
All right, thank you, Julie, appreciate it. Oil prices, meanwhile, they're dropping again as President Trump works to keep peace between Iran and Israel. The conflict in the Middle East hasn't had a significant impact on oil flows, but investors still keeping a cautious eye, we know. We're joined now by Rebecca Babin, senior energy trader at CIBC Private Wealth. CIBC Private Wealth has $100 billion in assets under management. Rebecca, it is great to see you. You are, in fact, Rebecca, exactly who I want to talk to about this, because we're looking at oil and it spikes, but now it's getting hit. It's tumbling again. I'm looking just at WTI here, Rebecca. We're down more than 5%. That's back down to 64.95. Explain these moves to us, Rebecca. I mean, what do we chalk them up to?
Okay, so what I chalk this move up to is essentially a recalibration of how the market is assessing supply risks. What we saw over the past 2 weeks when WTI and Brent rallied in the neighborhood of 20% was this growing concern that as this conflict escalated, there was real risk to supply in the Middle East. And when there was very, very heightened concerns, particularly around the Strait of Hormuz, where 20 million barrels a day of crude flows. It was always seen as a low probability, but as that probability grew, that's a huge impact. So we saw this kind of upside tail hedging take place where there was a tremendous amount of short covering and there was a lot of people buying options to kind of get that upside exposure should that tail event happen. What has occurred is that tail event, based on the recent kind of ceasefire headlines and various things that are unfolding, is shrinking. And all of those positions are being unwound very quickly. And the reason for that is underneath all the geopolitical kind of headlines and risk is the fundamental picture in crude, which actually looks a little bit fragile and oversupplied in the second half of 2025. So if your catalyst was supply risk, and that's what you're playing for, the only reason why you had the trades on for the upside, and that kind of probability has shrunk to somewhere much smaller than it was over the weekend, you're bailing out very quickly and not hanging around to see, oh, is this the bottom in crude, or where do you think it settles out? No, you just want out. And that's exactly what traders have done over the past 2 days. This trade didn't work. My catalyst isn't realized. I'm unwinding, and let's just call it a day.
What happens, Rebecca, if the conflict ramps back up in the Middle East? Because with Israel and Iran, we don't, of course, have a peace deal. We have a ceasefire, which is something very different.
Yeah, I think that's a really good point. We don't know how this plays out from here. But I will say this, traders are not going to hang around to see what that looks like because they're as afraid of this downside scenario on fundamentals to something in the low 50s. Right. So even though there's a chance that it re-escalates and supply risk comes back to the forefront, we've seen how this has escalated and supply was not disrupted yet again. Right. So when we look back at Russia, Ukraine, we had these big spikes. Supply was not disrupted. It faded. We saw this situation escalate. Again, supply not disrupted, faded very quickly. And now you're looking at a downside where you're like, this is a big downside. My risk reward doesn't make sense for me to play that. It doesn't mean the risk isn't there. It just means when you are calibrating between how much downside you might carry for the upside, that trade might not just look as good.
Another question I have for you, Rebecca. President Trump, right? He's posting on social media. He's posting drill, baby, drill. It is a Trump mantra. It's a Republican mantra. You saw that, Rebecca. Do we actually see, in your opinion, a meaningful pickup in U.S. production?
I do not think you see a meaningful pickup in U.S. production unless crude prices are meaningfully higher than they are right now. So let's call this strip right now at 65, and it's slightly lower further out. I do not think U.S. producers are going to see this price action and say, you know what, this is a great time for me to be putting money into my CapEx and getting more crude out of the ground. Why? OPEC Plus is bringing back more barrels into the market and likely going to pressure prices. So I might be putting my investment into a market where other sources of supply are also coming onto the market. They're also going to look at the recent volatility and say, okay, this is a different picture than I'm comfortable with in terms of the amount of volatility in the price action. Maybe I actually step back and wait and see how things play out before I go put my dollars in and try to produce more crude. So I don't think that that's going to be the initial reaction from U.S. producers. They will respond to higher prices and price stability. And if we get those two things, they will absolutely start spending money and bringing out more barrels. I just don't think that that is the environment we're in, and I don't see that in the near term. And all of the data supports that. If you look at rig counts have been falling precipitously over the past 3 months. This isn't an environment where they want to ratchet up the risk. If anything, they want to shore up their balance sheets and make sure they can survive this cycle and come out really strong the other side.
Rebecca, we're always lucky to have you on the show. Thanks so much for joining us.
Thank you.
All right, let's continue this oil discussion now. We have our ensemble, Julie Hyman and Chris Versace here with me. Chris, your thoughts on oil prices?
Well, I too am watching this pop and fade in what we're seeing, but I think that the comments made about understanding the supply-demand dynamics, those are always key, no matter what the commodity is. But as we look ahead, if the economy is slowing and we're seeing more capacity come on stream, it may not be the place that we want to be.
Julie, get your thoughts as well as what are we seeing with energy stocks?
Yeah, if you look at energy stocks and what we've seen year to date, we've not seen them perform well, at least collectively, right? The XLE, the ETF that tracks the large cap energy stocks, is kind of unchanged. We call it a MEP performance, right, year to date, although it has done much better than underlying oil prices themselves. But when you talk about the dynamics, and some of this was what Rebecca was just talking about, what is going to convince these oil companies to drill more? Is it going to be jawboning from President Trump, or is it going to be the dollars and cents? Well, my vote is with the latter category there, although the former category might have some sway as well. But nonetheless, production has been rising, is near record levels already. And obviously, these guys do not want to cut into their profits by over drilling, especially if we start to see oil prices come back down significantly. So it's just something that if folks are talking about thinking about investing in some of these energy companies, it's a tricky line that they are trying to toe right now.
All right. Thank you, Julie. Thank you, Chris. Appreciate it. Well, decades of expansion in U.S. oil drilling significantly impact the Trump administration's ability to manage Iranian hostilities. This expansion bolstered U.S. energy independence, shifting the country from being heavily reliant on Middle East oil imports to becoming a major exporter. It's given the U.S. some leverage, but it's not without its geopolitical challenges. Our Washington correspondent Ben Werschel joining us now to put this history into some context. Ben.
Yeah, Josh. So this, as you guys have been talking about in the previous segment, this oil story is kind of the story that wasn't over this conflict so far. Oil prices are now down below where they were 12 days ago when this conflict got underway. And this is because of these historical trends you're talking about, which is that U.S. oil production has grown tremendously. It's nearly tripled over about the last 15 years. This is a trend that spanned Democratic and Republican administrations and has been driven by the fracking boom. A stat I learned sort of reporting for the story today is that about 2/3 of U.S. crude oil production is in part due to fracking. So fracking is what's driving this, and it's what's driving this in expansion. And as you mentioned, this really does change some of the geopolitical calculations that we've seen. A lot of analysts have been out front to say this shows that the U.S. economy is more buffeted from oil price shocks going up and down than it has been in the past, and kind of gives the president, like President Trump, more leverage to weather these. Doug Holtz-Eakin of the American Action Forum has made this point strongly. And there's also really interesting academic literature about how the just increased number of people that work in the oil industry in the U.S. means that oil prices are good for them, and it kind of balances things out macroeconomically, at least in the U.S. economy, when oil prices rise to a modest amount. Obviously, there's real limits to that, and we saw some commentary from Federal Reserve Chair Jerome Powell before Congress today, sort of underlining how the limits are here, which is what you've been talking about, which is that oil companies make their own decisions about drilling. Trump likes to say he can watch companies and ask them to keep oil prices down or drill new wells, but they make their own decisions. And as Powell said today, this sort of a shock absorber, there's some questions about how durable this will be going forward, but it's clearly a change from what we saw even 15 years ago.
All right, thank you, Ben. Appreciate it. The start of Tesla's Robotaxi test apparently didn't go as smoothly, perhaps, as the company touted. Yahoo Finance's Praz Submarine is here with that story. Praz.
Yeah, we're just showing that the Hollywood set where they did the actual presentation last October didn't go exactly as planned. I mean, we saw a lot of the Tesla stands excited about taking their Robotaxi rides, but there were some hiccups, right? We saw some of the videos that they were taking. Some of the vehicles were speeding above posted speed limits, and then most egregiously, there was an incident where a car, you see right here, attempted to turn left, didn't actually do that, went straight through a left-hand turn only lane, and then crossed a double yellow, as you see here, which is also a traffic violation, major one actually in Texas. So NHTSA says that they're aware of these incidents, they're monitoring them, that they'll take necessary actions to protect road safety. So NHTSA is kind of possibly getting involved here. Meanwhile, Waymo entering Atlanta, like they said, said, they're officially open for business with partnering with Uber as their sort of platform partner. So, Waymo's with Uber in Atlanta and also Austin, where Tesla's test is going to take place, and then also in LA, San Francisco, and places like that.
Do you think, Praz, you hear about something like this, could it in any way slow down, disrupt the expansion of this service across the country?
You mean these little hiccups here? It kind of brings a little bit of the enthusiasm down. It's not ready for prime time, right? They have the safety rider sitting in the passenger seat. You have teleoperators who are remotely watching the car. A lot of Tesla investors are excited about the fact that this test actually started. It's happening, but they have a long way to go to catch up to Waymo, which is doing 250,000 completed Robotaxi trips a week without sort of these incidents that we're seeing right now with Tesla.
All right, let's bring in our ensemble now for more on the ride shares today. Tesla got it. Google, Uber, Lyft, they're all in focus. Julie, Tesla did slip a bit today. Of course, it had a nice pop yesterday, though, as Prost rightfully points out, as Musk begins this journey here, he's got some big competition, including Waymo.
Yeah, I mean, and if there are these hiccups, I mean, as we know, federal regulators have sort of left it up to states and municipalities whether they're even going to allow these things to go forward. You see it going forward on a city-by-city basis, right? So even though Tesla is still proceeding with its test in Austin, if it continues to see, I mean, like, we're calling it hiccup, but, it could have been a lot worse, right? So the question is, how is Tesla addressing these issues? And then the next question is, when Tesla goes to apply for its next approval in its next city, is this going to inform that? Is this going to then cause some friction with letting that move forward? Now, we always know if we're on an Elon Musk timeline, we can't necessarily expect things to happen as he thinks or says that they will. But this is just one more thing to consider when we're talking about that sort of speed to market and then capturing that market share.
Chris, I want to bring you here as well as the one person on the panel who actually has a portfolio to run here. What do you make of this big fight? I got Tesla, Waymo, got Amazon in there, Uber, Lyft.
Yeah, it's kind of a crowded space, and it's kind of an emerging market. I think this is going to be proven out over time. I think that the interesting way to play it from a differentiated way is maybe we don't focus necessarily on what Google is doing or Tesla is doing, but what does this mean for Uber? What does this mean for Lyft when we think about the removal of a key cost for them, right? And the amount of incremental profits that can drop to the bottom line once they have made these investments. To me, that's a lot more exciting.
All right, thank you, Julie. Thank you, Praz. Appreciate it. That is going to do it